Hey, welcome to The Explainer. Today, we're going to pop the hood on the stock market. You know, look past all those big, flashy numbers you see on the news and find out what's really driving the engine. We're going to figure out how to spot some of the market's most important warning signs. So you see the market hitting new highs day after day, and you think, wow, everything must be going great, right? But what if it isn't? The real question we're diving into is this: is a rising market always a strong market? And honestly, the answer might surprise you. You see, that headline number, the S&P 500 hitting another record, it doesn't tell the whole story. It can actually be a bit of a magic trick, you know? It hides what the vast majority of stocks are actually doing. Sometimes that index is getting dragged higher by just a handful of huge companies, while most of the other stocks are already starting to fall. So, if you want to get the real story, you've got to know where to look. We're about to dive into the market's hidden signals and how you can start to spot them for yourself. And here's the secret. You have to stop looking at an index like the S&P 500 as just one thing. Instead, think of it like an army of 500 individual soldiers. And we have to ask, is the whole army advancing together, or is it just a few generals way out front while the troops are actually falling behind? That's what we need to measure. And here's the best part. You really only need two simple but super powerful tools to do it. So let's break them down right now. Okay, tool number one is the moving average. Just think of it as a way to filter out all the crazy day-to-day noise. You know, the big up days, the sudden down days. It just smooths everything out into a clean line that shows you the real underlying trend. Is the price generally heading up, or is it starting to head down? That's what it tells us. In our second tool is something called market breadth. I absolutely love this analogy. It's basically like taking attendance in a classroom. When the index is going up, we're just asking, okay, how many of the 500 stocks are actually here? How many are participating in this trend? Simple as that. All right, now for the magic. This is where we take those two simple ideas and combine them to create something really, really powerful. This is how we get a true health check for the entire market. So it all boils down to this one simple question. We look at every single one of the 500 stocks in the S&P, and for each one we ask, is its price right now above its long-term trend line, its moving average? Then we just figure out the percentage. It sounds so simple, but the answer it gives us is incredibly revealing. And that brings us to our key number, 50%. This is our line in the sand. Think of it as a super simple rule of thumb for quickly judging the market's internal strength. So here's the rule. If more than half the stocks are trading above their moving average, that's bullish. It means our army is advancing together. But if that number drops below 50%, that's a bearish warning sign. It's telling us that the majority of stocks are actually getting weaker, even if the main index hasn't started to fall yet. Okay, so now that we've got our tools, let's actually put them to work. We can use them to spot trouble brewing on the horizon, everything from little dips to major market corrections. We can also use different moving averages to kind of gauge how serious a pullback is. Think of it like a series of alarms. A break of the short-term 20-day average? That's a small alert, probably just a brief dip. The 50-day? Okay, the alarm gets louder. This is getting more significant. But a break of that long-term 200-day average? That's the final siren. It's telling you a major correction is probably on its way. And all this leads to what is probably the most powerful warning sign of all. It's a concept called divergence. This happens when the headline index is still going up, but our breadth indicator, our army of stocks, is quietly starting to go down. They're literally marching in opposite directions. And here's exactly what that looks like. You'll see the S&P 500 index push up to a brand new high. But at the same time, our breadth indicator, the percentage of stocks above their moving average, it fails to make a new high. In fact, it makes a lower high. That tells us that fewer and fewer soldiers are supporting this new peak. The foundation is getting weaker. Let's walk through a textbook example. So back in January, the S&P hits a high, and breadth is really strong, like 80% of stocks are participating, super healthy. But then in February, the index just barely makes a new, slightly higher high. And look, breadth has totally collapsed to below 50%. That right there is a classic divergence. And guess what happened next? In March, the market started a major correction. The warning sign worked perfectly. So why does any of this matter right now, today? Well, because when we apply this exact same analysis to the current market, something starts to look very, very familiar. Just take a look. Right now, in September, the S&P 500 is making new all-time highs. That's the headline. But under the hood are breadth indicators across every single time frame, 20-day, 50-day, 100-day, 200-day. They are all sloping down. The short-term trend is weakening, the medium-term trend is weakening, even the long-term trend is weakening. Fewer and fewer stocks are participating in this rally. Now, let's be really clear. This is not a guarantee that the market is about to crash. It's not. But it is a very clear, very early warning. The red flag is definitely waving. The market's internals are showing some serious weakness, even while the index itself is pushing higher. So, what's the key signal to watch for now? Well, the divergence is the warning, but the confirmation comes with a break below that 50% level. If our breadth indicators fall below that line, it pretty much confirms the weakness is taking over and that a market top is likely in. Which really just leaves us with one final thought. Now that you know how to look under the market's hood and you know how to spot a divergence between the index and its army of stocks, what are you going to be watching for in the weeks ahead? Thanks for joining us.